Hello everyone, welcome back to another FinMeUp Weekly Stock Watch, where we cover the most important stock market news that happened during the week, all summarized with extra insights so that you can save that time and also just get some free insights. So today we'll be looking at a few companies: Omnia, Stor-Age, Stor-Age, Afrimat, Mr. Price and Stadio. And we'll also be touching quickly on Bitcoin. A lot is happening in the Bitcoin and crypto space, so we'll quickly touch on that. First of all, CPI is slowed down in South Africa, which is great news. It's slowed down from 6.8% to 6.3%. As we know, the average consumer is under pressure, so seeing that the inflation is lowering, as well as the potential that interest rates is probably at its peak, but we'll have to see, is great news. So happy to see that. Hopefully it can come down even more, and hopefully we can see some sort of pause, or even not too far in the future see lower interest rates. Anyway, let's get into JSE stock market news. Omnia Holdings. Revenue increased by 24%, operating profit increased by 19%, and the headline earnings per share increased by 10%, and they declared an ordinary dividend of R3.75, which represents a 36% increase in that dividend. The net cash decreased by 23%, and the net asset value increased by 2%. Paul, any thoughts on Omnia's results? I know you've written a stock pick on them on the FinMeUp app a few months ago. So what do you think of them at this current time?
Yes, I quite like Omnia. I think it's also Anthony special, and the share price actually performed quite well the last few years. They are mainly into agriculture, mining, and chemicals, and especially for the agriculture segment, the rains that we've been seeing. I'm freezing at the moment, but that's not bad for the farmer. So I think that's definitely positive looking into the year ahead. So the soil is in great good condition. So the last few years they had a debt problem, which they have now sorted out. They're basically debt free now. So especially for a small and mid cap, that's great news. The share price also did very well, like I said, and you get a juicy dividend. They have a very, very juicy dividend, especially for a small and mid cap. Given the results, I think the results are pretty solid, but the market didn't respond positively. The share price is down 6% on the news. Perhaps the market expected a little bit more from them, but for me, this is not bad results. They also announced share buybacks, which of course I know you're a big fan of. So still trading at an 8 PE, share buybacks. We have the rain, positive results. So I think Omnia presents opportunity. Maybe not a massive punt, but I think there's potential in the stock, yeah.
Yeah, I mean, well, I love a stock buyback at a price that makes sense. So it doesn't help you do buybacks when you are extremely overvalued, but when you're undervalued, it really makes sense. So as you mentioned, they are in agriculture, mining, and chemicals. The agriculture segment did really well, increasing revenue by 31%. Mining also did really well, increasing revenue by 28%. The lacking department or segment is the chemicals, which actually experienced a decrease in revenue by 8%. So some mixed results, two segments seeing really good results, one seeing bad results. Omnia, the first time I looked into Omnia, I thought it's a chemical business. So seeing that the mining and the agriculture is doing well, it's good to see it, some diversification. The next company, Stor-Age. The rental income and net property operating income increased by 17.3% and 15.3% respectively. The same store rental income increased by 9.8%. They achieved a rental rate growth of 7.6% in South Africa and 8% in the UK. The net investment property value increased by 12.2% to 10.4 billion rand. The loan-to-value ratio of 30.8%, with over 83% of net debts subject to hedging. And then, just to summarize, earnings is what people care about. Profit is what people care about. The earnings per share decreased by 34%. Dividends per share increased by 5.6%. And as we know, they invest a lot in new developments, and that's probably why we see lower earnings. Paul, any thoughts on the Stor-Age? I know between the two of us, you are definitely a bigger property man than myself. So let us in. What's your insights on Stor-Age?
Yeah, let's quickly chat about property. So property, very interesting. In South Africa, the last 10 years has really suffered. The 10 years prior to that, it had a massive run, and people were very, very bullish on it. It became overvalued, all the REITs basically on the JSE, and it plummeted in the last 10 years. Of course, the share price isn't that much of a deal as a normal company, and the reason being they have to pay out by law massive dividends. So as we know, the moment you pay out the dividend, the share price drops. That's just the interaction there. So you do get a very nice dividend. Stor-Age, on the other hand, has actually been doing very, very well. They're exclusively into self-storage, the only self-storage property REIT on the JSE. So it's not a growth point like where they invest in the waterfront or commercial or residential. It's just self-storage. They operate in South Africa and the UK. And a few trends play into self-storage. People moving into smaller houses, people hoarding. You just can't get rid of that stuff that you love, but they don't have space for it, but you still keep it. And then also short-term movements, like people that's going through a divorce or moving. And due to the short-term nature of these agreements, is normally the contracts are, very short in nature. You get a lot of new people and you lose a lot of people at the same time. Yeah, but what I like about Stor-Age is the business model. It's very simple. It's self-storage. There's not a lot to think about. It's not like a mall where, let's say, you have a Checkers, then the Checkers moves out and you have to redesign everything, and maybe you get a new tenant in on a new company or not, or a residential property where things can break and things can go wrong. This is simple self-storage. What you see is what you get. So there's nothing to think about. Just look at the numbers and you decide for yourself if this company undervalued or overvalued. Then, and maybe a last comment, REITs versus bonds. So people are saying maybe REITs are now undervalued, especially a company like Stor-Age. That's easy on the eyes. It's a simple company. You have to so that's the one narrative. Maybe REITs can play quite a role, can do quite well in the next 5 to 10 years. The other narrative is REITs versus bonds. Which one is better? Because they have the same properties. They both pay out a massive dividend. Capital growth isn't as important as distributing the income. And at the moment, bonds, I think, are poised to do very, very well. So that's also something you have to flip. Do I go for the REIT or do I go for the bond?
Speaking on bonds, I've started investing in bonds as a diversification. I do that through Paul. So if you want to learn more about bonds and get some insights on bonds, you can book a call with Paul right over here. The link is in the description. Book a time, choose a time, and ask him your questions regarding that. So just finally, also on Stor-Age, on the deal-making side, they've been quite busy. So they commenced trading of 2 joint venture developments shortly after the year end, and that is both in the UK and Morningside. But in the year end, they entered into a joint venture with Nuveen Real Estate and acquired the 4-property Easy Store portfolio in the UK. So lots of deals happening. 6 developments scheduled before the end of the financial year 2024. 3 in SA, 3 in UK. So lots of developments going on, lots of deals. We'll have to see how that plays out. Just quickly on the net asset value, the net asset value per share increased by 8.3% to 14.83 rand. And they declared a final dividend of 58 cents. For the overall year, the dividend per share was 1.18 rand. So, for the dividend lovers, there is something for you. The next company, City Lodge, for those who like traveling and staying in hotels, their earnings per share are expected to show over 100% improvement from the previous year's results. The travel trends are rebounding and demand patterns have normalized to pre-COVID-19 levels. Monthly occupancies have steadily improved, surpassing the 2019 levels, with March 2023 reaching 63% of occupancies. The food and beverage offerings contribute approximately 17% of the group's total revenue. Improved financial performance has resulted in a near neutral net debt position. So the borrowings is just 3 million rand more than the cash position. So really showed some recovery there. And finally, the group has access to additional unused debt facilities and overdraft facilities. So the positive, look, the earnings per share, the headline earnings per share, expected to show over 100% increase. It's not a massive surprise. The reason for that is, remember what happened with COVID-19. People didn't travel. You just couldn't really travel. And now we're seeing tourists coming back to South Africa, seeing people move more, travel more in-person business meetings, and that helps a company like City Lodge. So, we're going to see a massive earnings per share increase. I wonder, we're probably not going to see the same amount of growth in the next financial year. But what we are seeing is we're seeing a rise in occupancies. We're seeing travel trends increasing and rebounding again, seeing tourists increase. So, and also the improved financial position. So there's a much better position for them between cash and debt. So, yeah, interesting to watch. A few of my friends actually love City Lodge just because of the recovery point of view, and the tourists is just increasing. Paul, what do you think? Are you bullish or bearish on City Lodge?
Yeah, like you said, the recovery narrative, especially on Twitter, I see people are quite bullish on this one. And yes, there's definitely a point to be made here. Like you said, leading up to COVID, the share took a massive hit. Maybe John, that you can put up the 5-year share price. It's not pretty, Higgo. It's not pretty at all. And since 2021, they've kind of muddled along. Actually, did like quite all right. Imagine having a hotel right before COVID as your main business. That's a nightmare. So like a hospital or a hotel, they have high fixed costs, and this means that it's all about occupancy rates. It's all about the volume-based game, and of course, in COVID it was a disaster. But now they're back to about 56%. The break even is around about 45 to 50%. So they're just above break even now, which is great because remember, having a high cost, it means that every single occupant or every single little bit of income actually makes quite a difference to the bottom line. So if they can go to 60, 65% in next year, that will actually make a massive difference to profits. So quite bullish there on the potential. Then they've also made some adjustments lately, like you see here, it's 70% the food and beverage offerings to the group's total revenue. They've made some adjustments to their food offerings, which is great. They've also sold some of their hotels in Kenya and used the approaches there to repay some of the debt. So that's everything is working out quite nicely. Let's see where this one goes.
The next company, Afrimat. This is a market lover over the past few years. They've performed really, really well, and the management is really known for their impressive capital allocation. The deals that they've made over the past years all played out well, and really, really impressive management. So Afrimat is to acquire 100% of Lafarge South Africa and its subsidiaries, which is a leading provider of construction materials in South Africa, and they offer products such as aggregates, concrete, cement, and fly ash. So there's lots of talk and lots of hype going around this deal because they bought it basically next to nothing. But when something is cheap, you have to ask yourself why it's cheap. But then again, you've got the management team who really knows what they are doing. But if you want more information on this deal and lots of insights on Afrimat, we interviewed Anthony. The video was posted this week. He spoke about Argent, Afrimat, Montauk, that includes Renogen, and Omnia Holdings. Lots of insights. It's a 44-minute video, so it is quite long, but it's packed with insights. Afrimat is one of them, and this deal is one of them. If you follow any of those companies, I'd really recommend you go watch that. I also learned a lot. The next company, Mr. Price, group revenue increased by 17%, which was aided by the acquisition of 70% of the Studio 88 group. EBITDA increased by 5.4%, which was impacted by load shedding during the festive trading months, and the headline earnings per share was down 6.8% and 6% respectively. So Mr. Price showed proper revenue growth, EBITDA growth, even though it was little, and earnings per share or headline earnings per share growth by 6%. So little growth, not massive growth, but in this economy, well done. They declared a final dividend of R4.47, maintaining a 63% payout ratio, and once again, load shedding having a big impact on the group trading division, resulting in a loss of approximately R1 billion in revenue. And then you've got rising inflation, interest rate increases, load shedding, all of that, which is why I'm not personally a massive retail fan at the moment. I'm looking elsewhere. I don't own any retailers at the moment, but it's interesting to watch. Paul, any insights on Mr. Price results?
Yeah, I think it's not bad results. The last year hasn't been kind to any of the retailers. And Mr. Price, revenue increasing by 17%, EBITDA 5.4%. It's not bad given the current economic circumstances. Of course, just maybe something interesting. Mr. Price obviously has the clothing, Mr. Price Home and Mr. Price Sport. The clothing department, it started in the 1970s as a random factory in Durban, and 50 years later, and it's one of the most popular retailers in the country. So big ups to the management and everyone who invested all these years. And what I quite like about Mr. Price in different market cycles is that they're kind of not their value play, but they're not bottom of the spectrum or at the top. So they're not a Zara or a Foschini, but they're not like a Pep either. So when it's going well, the Pep guys can say, okay, maybe I'm going to treat myself and buy a nice Mr. Price fashion item. And if it's not going well, like at the moment, these middle to higher LSM groups can come down a little bit, and there is something for them at Mr. Price. So I kind of like that you are protected against certain market cycles in that regard. And furthermore, like you said, I don't think there's nothing that excites me about retailers at the moment. I just hope for the best and hope that the cycle, favors them again soon.
Yeah, the thing is, they showed great growth. I mean, that's proper revenue growth. If you look at the group, retail sales grew by 18%, total store sales grew by 18.5%. But the thing is, their total expenses increased a lot. But that was also driven by the inclusion of Studio 88, of course, because there's just much more, operating expenses now. But the total expenses increased by 21.2%, which is more than the revenue growth. And also their gross profit margin declined a little bit. So, it's good results, but once again, it's just a retailer in South Africa in the current climate. It's challenging, but I mean, kudos to them. It was really good. The final company, and then we'll quickly look at Bitcoin and crypto, is Stadio. So they just held an AGM and just gave a business update. The distance learning, also what they're seeing most of their growth, they reported at 35,822 students, showing a 10% growth compared to the previous year. Where a little bit disappointing was their contact learning growth, which is now 5,762 students, which only shows a 2% growth compared to the previous year. Look, private education, there's a massive opportunity. There's no doubt about that. The thing is, we are in an economy that people just, they really need to look after their budgets, and Stadio is probably not the cheapest out of all the options out there. But look, it's a massive opportunity. I still believe in Stadio over the long term. I don't think in the short term it's really going to spike or anything like that. But over the long term, I like the management, I like the offering, and I like the opportunity and the size of the potential market, and the fact that distance learning is the biggest part of their business and the fastest growing segment. I like that. It doesn't consume it too much that the contact learning is not increasing that much because it's not scalable. With distance learning is scalable with lower investments required than the contact learning. So overall, it's slower growth than I anticipated and hoped for, but still they are showing growth, and still I believe in the long term of Stadio, and it's going to be interesting to watch how it all unfolds. Paul, any thoughts?
Years ago, you and I have chatted about Stadio quite extensively. I also like Stadio. I think there's a massive opportunity. I mean, obviously the main narrative being Stadio versus Unisa, or basically Unisa versus everyone else. Do you see Unisa gaining or losing market share? Personally, I don't see them gaining market share, just because I've used Unisa, I've tutored Unisa students. I don't think Unisa is the best, especially admin-wise. People always complain about that. So there is opportunity for companies like Stadio or Advitech or even Kiro later down the line. Then the other narrative is the democratization of the information. Like, you get so many alternatives. The world is getting smaller by the day. Opportunities offshore, or not like online learning, maybe the University of YouTube, like people are learning insane information free of charge. Obviously, you don't get the stamp, you don't get your official degree, but you do get the knowledge. So we'll see where it goes. I think long-term Stadio will do very, very well. But like you said, in the short term, I can't see this company eating the lights out ever.
Yeah, it's going to be interesting to watch. Now for the exciting one, Bitcoin and crypto. Lots have been going on over the past week and so. Before we get that, if you have a dog or a cat, we launched PetMeUp. So it is personal, tailored pet insurance for your dog and your cat. So the link is in the description. We worked really hard at this product, on this product, and excited to finally share it with you. So the link is in the description. You can go get a free quote within a minute on that link. Now, Bitcoin. So what's happened the past week? 3 weeks ago, we saw massive SEC file lawsuits against two of the biggest exchanges, Coinbase and Binance. So there was that, and now all of a sudden we're seeing massive corporates wanting to get some skin in the game in Bitcoin. So whether it's custody services or creating Bitcoin ETFs, which is the big one that we're going to talk about, that includes big names like BlackRock, which is the biggest one of them all. They want to create a Bitcoin ETF. Citadel, there's Deutsche Bank, there is a bank in France. There's quite a few of these big corporates and asset managers who all of a sudden now either want to do an ETF or something to do with Bitcoin. Now, that is bullish, and that is why we saw a 10% or 12% increase in the Bitcoin price the last week. Personally, I own Bitcoin. I know Paul owns even more Bitcoin than I do. He's done his research on Bitcoin for many years now. And it's a very interesting concept. And what this does, as I've just spoken to some of the people at the office and so on, is those who don't own Bitcoin said if Bitcoin is available through an ETF, they will probably buy the Bitcoin ETF because it just feels safer. It feels backed by institutions and it's more accessible. Like you don't have to open Bitcoin on a separate stock exchange and go buy your hard wallet so that you can put it on private. It's just more easier. It's more accessible, which will give more people access to actually buy Bitcoin. There's lots of arguments against Bitcoin. There's lots of arguments for Bitcoin. If you want us to do a video specifically on Bitcoin, it's probably going to get a lot of love and maybe even some hate because there's lots of people debating about Bitcoin. But if you want us to do a proper video discussing and just debating this Bitcoin thing, let us know in the comments. If we get a few requests, we'll certainly do that. Paul, what do you think of all this news and what does this really mean for the crypto industry? We know that the Bitcoin halving is happening around April, May next year, which historically, 10 months, if you buy 10 months before the halving and sell around 16 or 18 months after the halving, you would have made a lot of money. But the thing is, everybody is expecting that now, so it's less likely that the cycle will repeat itself, but who knows? We are seeing early bull market signs. Paul, what do you think of all of this news regarding Bitcoin?
I have a smile on my face this morning. Of course, I'm a Bitcoin bull, but that doesn't come without controversy. Some of my smartest friends, on the one side, you have the guys that basically sold their house and their kids and their wife to buy more Bitcoin. And other half, the guy says it's a glorified Ponzi scheme. So we'll see how it turns out. Of course, personally, I do believe in Bitcoin. I think there's a bright future should everything, but should the stars align, because there's also potential that it does not work out. But I feel that the potential for it working out is much greater than not. And then what happened? So it shows you how quickly the narrative can change in the crypto industry. I mean, 2 to 3 weeks ago, the SEC was suing everyone and people were saying Bitcoin is dead or whatever. Now, 3 weeks later, people are counter-suing SEC. Gary Gensler, the guy at the top of the SEC, is getting sued. There's now a notion to get him out. 3 of the biggest asset managers are fighting for ETFs, and it happened like that. And what I love about this new move is that it gives people confidence. It makes them feel safe. Now I can actually buy Bitcoin without actually buying Bitcoin. Like, people don't understand. You go, especially the people with the money. Remember, we are not the people with the money. The people with the money are 40 years and older, and they're sitting in America and other developed countries. They have to invest for the price to go up. Not only retailers, especially institutions. So how do you get these people in the game? You tell them, open an account on Kraken or Binance, and then remember 2-factor authentication and blockchain. They're like, what are you talking about? Put it on a hard wallet. Now all of a sudden the game has changed. We now have ETFs. So now you can almost invest in it as if it's a stock. So you invest in the ETF, then the asset manager or the product provider then goes and buy that actual Bitcoin. So for it to have a backing. So in other words, every time a retailer or institution now buys the ETFs, that Bitcoin is actually being bought in the market, which is going to drive the price up. So very, very bullish. Let's see if it gets approved. If it doesn't get approved, the excitement will die and we'll probably continue to trade flat. If it does get approved, and with simultaneously the lead up to the next halving, I can see Bitcoin going to 100,000, middle end to 2024. But of course, this is not financial advice at all. Like I said, the stars have to align, but I think the chances are much greater of it happening than not.
Yeah, the big debate was institutional adoption. Like, everybody knew if institutions adopt Bitcoin, that the price will skyrocket. But like you said, it first needs to be approved, first of all, and second of all, then it needs to be adopted. And then you need the entire narrative of the retail market to also get excited about the about the halving. So lots still need to happen. Once again, there's lots of risks with Bitcoin, but it's very, very interesting. It's an entire new concept, but it's now been there since 2009 or what. So it's very interesting. Let us know if you want us to do that video on Bitcoin. It's a discussion that can go on for hours and hours and hours. There's no right or wrong. So let us know if you want to discuss that. Hope you enjoyed today's video. If you found some insights, consider liking, and if you want more of this, subscribe, and also remember to watch the Anthony video for more insights on JSE small caps. Thanks for watching. Hope you have a great day. Cheers.